Well, it was publicized and disclosed. I think it was last week that we had responded to the SEC's request for information around our Bitcoin filing, and we responded. And that's basically all we can say. I think many people think the fact that the SEC chose to ask questions is a change in behavior. And therefore, I do think hopes are rising that a number of Bitcoin ETFs will be approved.
I think we have a couple conflicting forces right now that history gives us a guide to, but of course not a perfect playbook for, which is basically that we're in what Ray Dalio would call a long-term debt cycle. There are other names for it. I've spent years researching it, looking into it. It's been very useful, not just in a theoretical framework, but for example, predicting inflation that we've had in recent years. And what that means is basically we spent the past 40 years constantly cutting interest rates to, whenever there's a recession, which helped get debts higher and higher and higher. And eventually we ran into the global financial crisis, big private debt, blow up, interest rates hit zero, and we pushed a lot of that up to the sovereign level.
We have a 5-year investment time horizon, are going to be substantially more than NVIDIA's, mostly because most analysts do not believe that autonomous as a taxi platform for Tesla is going to be a part of the story. We disagree. And with that, we see incredible revenue and margin expansion. NVIDIA's margins are already quite high, having entered the 70s, the gross margins. Tesla's are in the 20s, and we think they will scale into the 60s and 70s as autonomous takes off. So Tesla, we believe, is the biggest AI project, or autonomous driving is the biggest AI project in the world. NVIDIA has been critical to providing the infrastructure to enable this and so many other things to happen. All praises to NVIDIA. We think that a lot of people understand how important NVIDIA is in this ecosystem, and they do not understand how much each dollar of hardware spent is going to pull software through. We think it's on the order of 20 times. So we think NVIDIA is going to be a good stock. We think the stocks in our portfolio, and we've written a paper on artificial intelligence. It's titled Investing in Artificial Intelligence, Where Will Equity Values Surface? You can read that on arc-funds.com and see how we're a really good diversification into this AI world. Many think that the winners are going to be the megatech companies who have had such strong performance over the years. We are not sure. ChatGPT could be the best thing that ever happened to Google, and that it lit a fire under Google to get its own AI into the market more profoundly. Or it could be the worst thing, in that it's going to lose its advertising franchise if we're all just on ChatGPT looking for our answers. Our confidence, if anything, has increased because of what's happening with artificial intelligence. Finally, ChatGPT captured the imagination of the investor. We had been talking about artificial intelligence since the firm started in 2014. And we had been very focused on NVIDIA as the pure play in this space. So we were there when NVIDIA was 5. We're on to the next thing now. And I would say you're picking early 21. The drop from early 21 in our strategies to the low was worse than the tech and telecom bust, which makes no sense. Back then, the technologies weren't ready, and the costs were too high. We didn't have the cloud, we didn't have deep learning and AI, we didn't have transformer technology. We were not ready for prime time, and the costs were prohibitive. Today, and yet, investors were chasing the dream back then. And that ended badly. Today, talk about investor psychology. We're ready for prime time. The dream is no longer, it's a reality. And investors are so fearful. And so we think that the surprise element out there, as our companies take off, harnessing these new platforms, the element of surprise is going to be significant, and we will earn our way back into portfolios. There are many who stuck with this and averaged down all the way. We think they will be rewarded handsomely if our research is correct. We think it is correct. Of course, we could always be wrong. Sure, most of the stocks in our portfolios are there because we've used an AI lens. Now, we wrote a paper called Investing in Artificial Intelligence, Where Will Equity Value Surface? It's on arc-funds.com. I think many people feel comfortable. They're on the right horses, the mega cap tech companies or the Magnificent Seven, one of which is Tesla. So we clearly agree with that one. We are not sure when it comes to the others. We think that AI is going to be highly disruptive, is going to disintermediate some of these platforms, not all of them, and that it may be the worst thing that has happened to a company like Google. Google, if I can go to ChatGPT and just get an answer right away and not be bothered with links and advertisements, I might do that. Well, guess what? Google is responding and now giving me answers. So it could be the best thing that happened to Google. We don't know. All I know is that when there are major changes in platforms, especially user interfaces, now that we're thinking about glasses and other wearables, the winners of the last round in technology typically are not the winners in the next round. So we're on guard in that regard, and we know that most large cap portfolio managers own all of these. Our portfolios are a highly diversified way to participate in artificial intelligence. For every dollar in hardware that companies spend on artificial intelligence, it will probably pull $20 through in software. So that's why you see a company like UiPath, Robotics Process Automation, which we think is harnessing the foundation models that OpenAI, Anthropic, and others, Meta's Llama 2, it's harnessing those foundation models, but is using specialized models with its proprietary data to become the robotics process automation company in the world, the largest. And same with Twilio. What kind of data? And you'll hear four variables that we think are critically important as all companies approach AI and try and figure out, how can I harness the productivity gains from this new technology? One is they have deep domain expertise. They obviously know what they're doing, and they have a vision about where their own technology and company is going in the future. They have artificial intelligence expertise. They're taking this seriously. They have good distribution, preferably global, not always. And then most important beyond that, they have proprietary data. And most of the companies you'll see in our portfolios have proprietary data that no one else has that they can use to help their customers.
During the 1920s, there was a big credit boom. So the amount of broad money and credit and total debt expanded a lot more quickly than the base money. It was leverage. And that all eventually hit ahead in 1929 and began to collapse. And even cutting interest rates to zero was insufficient to re-blow that bubble. So it actually started to fully collapse. And that lasted for a number of years until 1932, when they decided, okay, we basically have to print now. And so they expanded the monetary base, bank holiday, but the problem is you can't, if your monetary base is backed by gold and you just expand the monetary base, you're going to have a problem with your gold. So then they repriced gold. They made gold illegal to own in the land of the free. They recapitalized the banking system. What that did was that kind of put America into like a economic malaise for a period of time where the crisis was over, but there was like this period of slow growth. private sector deleveraging. Some of the leverage was brought onto the public sector. And then you had a long period of rising populism. And of course, that was happening in Europe as well. That was happening in other countries. And that populism in multiple countries eventually contributed to World War II. And then we had kind of the second phase of this crisis, which was a gigantic public debt bubble across the developed world, large amounts of money printing. Unlike the Great Depression, that was more outright inflationary. And what they did in the 1940s in the US was they did yield curve control. So they said, okay, I mean, inflation's averaging 6% this year. I mean, this decade, inflation reached as high as 19% year over year in the United States, which was higher than even the peak of the 1970s. And yet they held interest rates roughly at zero, and they even pegged the long end of the curve at 2.5%. And so if you were holding bonds or cash, you just got completely killed on a real basis, even though you got paid back every dollar. And that's basically how they recapitalized themselves. They, if you were holding debt, you basically got defaulted on in real terms. We entered kind of that next era. And there's certain similarities today, which was during the 2000s decade, there was a gigantic credit bubble relative to the monetary base. That all blew up in 2008. They recapitalized the banking system by expanding the base money for the first time at that speed since the 1930s. That was a kind of a disinflationary crisis because you had a partial debt deleveraging, you had some money printing, but you didn't have a big increase in the broad money supply. And then, we had this decade-long period of rising populism. You had Tea Party, Occupy Wall Street. You had more and more political division. Just kind of an era of politics that was, very different than, kind of the middle of this past century, for example. And then, there's eventually some sort of catalyst. In this case, it was COVID. But when something like that hits a highly levered, highly polarized system, you get, bigger than normal responses to it. It looked a lot like wartime financing, a lot like the 1940s, which is why I began making that comparison so much. And so we've been in this era where now it's more inflationary. Now it's more the broad money supply itself is being inflated, or at least was until very recently. And the debt is now fully a lot of it's on the sovereign level. So you get to the point where if you have over 100% debt to GDP, interest rates become a more mixed tool for fighting inflation, because in addition to higher rates pushing down private sector credit growth, which is disinflationary, they also completely blow out the fiscal deficit, which tends to be more inflationary. And so the ability of central banks to fight inflation gets harder. I think a way of phrasing it is that most of the tools that central banks have are designed to accelerate or decelerate credit growth. And they don't really do anything about fiscal-driven inflation. And yet that's what we've had. And at a certain point, there's so much debt that their tools that affect credit growth can actually make the fiscal side worse. And so we that's why I think we're in the later stages of this overall kind of long-term debt cycle.